Well, we're here this afternoon doing a few videos with some of our colleagues over from FSA, really to get the word out and help people in their response to the after effects and the damage caused by Hurricane Harvey. And many of you would know that USDA FSA has a number of programs to help farmers and ranchers recover from disasters just like this. And so it's really great to have Fred Greenway with us this afternoon. And Fred's in charge of FSA loan programs, farm loan programs with FSA. So I'm going to ask him to just take it away and talk for a few minutes about those loan programs that they have available for farmers and ranchers in dealing with the storm. So Fred, take it away.
Thank you, David. The emergency loan program is probably one of the primary tools that we'll use to help disaster victims suffering from Harvey. The object of the emergency loan program is to try to help eligible farmers and ranchers that suffered eligible losses due to the hurricane recover from those losses and give them some time to repay those damages and losses that were incurred by the hurricane. It's a fixed rate of interest for the life of the loan. It currently is 3.75%, and it has a maximum loan limit of $500,000 or the amount of the actual loss.
So your initial explanation here, I got a lot of questions, and I'm sure a lot of other people are going to have questions too. So let me start with a couple of these. So we're really talking about emergency loan program funding, which we're dealing with emergencies right away. So what can a farmer use the money for?
David, primarily the loan purposes are used to restore or replace damaged property. One of the big things that we use emergency loans for is to pay essential family and farm expenses, family living expenses, and those things. When we have these disasters, it always disrupts the income stream of an operation, and a lot of folks don't think about it until that disaster knocks on their door. But a lot of things that we see from applicants in previous disasters that they have life insurance premiums, health insurance premiums, groceries, fuel, and all of those essential things that family needs, and that gets disrupted to where they cannot make those payments and keep those things current. And so one of the main uses we use the emergency loans for is to replace possibly a whole year's worth of income to that farm family. Oftentimes, whether it's a crop or a calf crop or whatever's lost, then they meet a situation to where they can't satisfy the family's needs. So we use a lot of the emergency loan money for that, a lot of emergency loan money to refinance some short-term credit like credit card debt and stuff that families start immediately using after a disaster. It's not intended for a long-term credit source, but we can go in and refinance some of those debts and then obviously replace damaged or destroyed property such as farm equipment, replace livestock that got lost in the disaster, of course pay them for crop losses, anything over and above what risk management agency would pay them under a crop loss situation.
Well, it's pretty easy to see that, the timing of the disaster could wipe out a year's worth of work.
Yes,
and
sir.
It really gives you a chance to
gives them an opportunity to stretch that recovery out over a few years at a low rate of interest, instead of trying to figure out how to pay for all that this
today.
year while we're trying to recover
Right.
from the disaster.
Right. Well, then let me ask about who's eligible for emergency loan funds or emergency loan programs like we're talking about here.
Well, they must have been an established producer and obviously had an operation in the designated disaster area, either a primary or contiguous county under the designations. They need to be a citizen or either a permanent resident alien of the United States. Obviously, they need to have the legal capacity to incur indebtedness. And one of the big things that we often deal with applicants with is they must be unable to obtain credit from private sources. And by statute, the USDA Farm Service Agency was never intended to compete with private lenders. In fact, by statute, we're prohibited from dealing with trying to make loans to folks who can actually get it down the local farm credit institutions or the local banks. So they must be unable to get credit at other commercial private institutions at reasonable rates and terms. Now, when we say reasonable rates and terms, a lot of times a commercial lender wants 20% equity in the operation, or sometimes their interest rate is prohibitive and won't allow a positive cash flow. So when we say reasonable rates and terms, we're talking about an operation that's trying to recover from a disaster, and you may not be able to meet those reasonable rates and terms of a commercial lender. So in the normal circumstances, you may have a lender that would loan you the money. Under disaster situations, that may not be the case.
All right. Well, that brings another question to mind. Since we're dealing with an emergency and a disaster type thing like this, are there any kind of deadlines that people need to know about to come into the office and visit with somebody, and other documentation or anything like that?
In the application process, the producer applying for an emergency loan will need to verify their acreages, their yields, and their physical losses such as calves or stored crops like round bales, or their basic cow herd. Document those on a form we have, FSA Form 2009, and they'll give them that at the office when they ask for an emergency loan application. But that's basically their self-certification of their losses, and that's where our loan managers and loan officers will go and calculate how much loan they're eligible for based on that self-certification. So that is the documentation we need there. If they've got livestock deaths, that would be similar documentation like the LIP program, the Livestock Indemnity Program, and we advise the applicants to start as soon as possible after the disaster to start getting that documentation in hand, whether that's pictures, some kind of documentation from a rendering plant or whatever, however you dispose of those livestock. Then of course crops, we have that information from the crop insurance agents and all of that. But on livestock deaths, fence, debris, damaged buildings, take the camera out and get that documentation as early as possible, and submit that to the county office.
So a lot of the documentation then is the same as some of the other programs. The stuff that makes sense for one is going to make sense for this as well.
Very similar, yes, sir.
Fantastic. Well, since we talked a bunch about emergency loan programs, are there any other loan programs that you handle that might be worth mentioning here that kind of fit in this same category to help some folks out?
Yes, sir. In addition to the emergency loan program that's authorized under the presidential disaster for Hurricane Harvey, the Farm Service Agency also has a direct farm lending program. It has a maximum loan limit of $300,000, and the agency also has authority to issue loan guarantees to participating ag lenders. And those maximum loan limits go up to $1,399,000. So with a combination of possibly the emergency loan, the direct loan program, and the guaranteed loan program, we should be able to touch just about anybody out there that's trying to recover from this hurricane.
Well, Fred, since we're talking about loans, oftentimes with loans, folks need to have some kind of collateral. So what type of collateral are we talking about for FSA emergency loans in this case?
David, obviously it's a loan program, and the agency does require the loans to be fully secured. If we're making an annual 12-month loan on a cow-calf operation or a row crop operation, we're going to look for the product that we're financing. So we're going to have a lien on the cattle. If it's crops, we're going to take a lien on the crops and expect those to be repaid in a 12-month operating cycle. When we go longer term, intermediate type credit, then we can look at basically equipment, equity in real estate. There's lots of options once we move past that 12-month cycle of an annual operating type loan. As we move into real estate type losses where we've had structure damage, maybe some topsoil washed away, maybe terraces washed out, whatever happened when we get a high water situation, then we're going to have to take a lien on that real estate that we actually improve or repair with loan funds. So basically, from a collateral standpoint, we do require the loans to be fully secured, but we're pretty flexible about whichever direction we go. We often have producers who don't have that collateral to pledge, David, and sometimes family members will pledge real estate as security or something like that we can use long term to help that person get a loan and survive and stay in the farming and ranching business. So we see all sorts of options and opportunities out there, but bottom line, they do have to.
Fred, thanks for coming over this afternoon. I think that was a great explanation of the emergency loan programs and other ones that people may want to find out some more information of. And I guess I could say the best thing is contact your local FSA office, come in and visit with somebody about your situation.
Absolutely. The sooner the better. We have to process these applications in the order that we receive them. So the earlier that you can get your application submitted to the county office, the better, because you'll get your loan worked sooner. And if you're not real sure about what type of assistance that is going to fit your losses, by all means go in and get an appointment with your local county executive director and farm loan manager, and just sit down and talk through your situation with them, and they can guide you in the right direction for the appropriate emergency loan assistance or disaster assistance program.
Fred, thanks for coming over.
Thank you, David.